Hello, everybody, and welcome to the Tuesday edition of the Not Your Average Investor Show. I'm Gregg Cohen. I'm so fired up to be here with you. And today we're going to be talking about the biggest mistake you make when it comes to cash on cash returns. I'm here with you. My partner in crime, both of my partners in crime are not here with you today. Pablo is off at a conference. Madison is off in Hawaii having fun. And so you get me today, but I'm so excited to be here with you. I want to welcome everyone in our audience. Thank you all for being here. Wow, over 30 folks already, and the numbers are growing and growing. First and foremost, listen, I need your help today. Without Pablo here, without Madison here, it's just me in this lonely studio. And so I would love all of your help, all of your engagement, your questions, your comments. You guys are going to drive this show. You know I can't do it alone. So thank you for being here. I hope you guys are ready to have some fun and interact. I will tell you that it's going to be really hard for me to watch what's going on in the chat. There's a lot going on over here that Pablo maestros. And so when you have a question, please put it in the Q&A box. That way I will be sure to see it and make sure that we get your question here live on the show. And while you're here, just say hello to everybody in the audience. We have such a community here now, about 40 folks here, and the numbers are growing here. So use this time, say hello to somebody, find a friend. You're going to find some incredibly savvy investors here in the group. And if you are joining us live on the podcast, well, that's awesome. I guess you're not live on the podcast. If you're joining us on the podcast, that's awesome. We love that you're taking in this wonderful information on the podcast. Hope you're enjoying it, but the real magic happens here. It is here in our community. It's at the Not Your Average Investor Show, and you can be a part of the audience, just like our audience is here today. So I want to invite you to do that. To be a part of the live audience, just go to nyais.com. That's nyais.com for Not Your Average Investor Show. You can RSVP there, and we're going to send you a direct link to join a future show. And when you do that, you get to be part of the roll call, baby. So we are going to get started with the roll call right now. And let's see who's checking in here today. First and foremost, let's see who we've got here. Denny Davies coming in first with his patented Guten Tag. Denny, welcome to the show. Great to have you. Bill Shields with his Buenos tardes, damas y caballeros. Great to see you. We got the touchdown maker, Shannon Baker, saying hello. We've got the leadoff batter batting fourth today, John Henning. Thank you for being here, John. We've got the MVP, none other than Mr. Lee Bishop, joining us here today. And we're happy to have you. We've got Joe Bussey, who's making a household name of himself. Thank you so much for being here. We've got Christopher Lee from Fernandina Beach checking in. We've got the second family, Rosalind and Gary Riley, saying, good morning, everyone, from Murrieta, California. Rosalind, we're still trying to figure out what to do with the second family as far as how to salute you. So we don't really know what to do, but we're happy that you're here. We've got Lewis Hudmill here from the best place to mispronounce, as my good friend Pablo would say, Milipitas, California. Great to have you there. We got the early bird, Dean Curry, checking in, saying hello. And we have our favorite nickname to pronounce, Aaron O'Neill, Into the Light. So wonderful to have you, Aaron. We've got Pops, my dad, Mr. J. Cohen. Pops, we love it when you call in, Big Papa. There you go, man. We've got Leslie Wilson, our real estate maven from Denver, saying hello. We've got Renee, and let me see the last name here. You know, Renee, I'm not sure your last name. Starts with a C. We are so happy to have you. Not sure if that's a new name. If it's a new name, we are so happy to have you, and welcome to the party. You're checking in from Hayward, California, in the San Francisco Bay Area. Love that part of the country. We've got Deborah Schwartz. We've got the Pablo's karaoke witness there. Deborah Shorts checking in. Good morning, everyone, she says. We've got the mountain man, Bill Green, checking in from the soon-to-be snowy mountains of Colorado. Great to have you, mountain man. We've got Joseph Seppi here from Jacksonville, Florida. I think that's a new name. We love our new folks joining, so thank you so much for being here. Joseph, let us know how you found us as well. We got Eddie Harris checking in from Hot Atlanta. We've got Awais Imam, another new name, I believe. So wonderful to have you, Awais. If you would, tell us how you found us, and we hope you keep coming back. We've got Nadeem Shah with his patented good morning, good afternoon, JWB family. Hope everybody is doing well. We've got Rena Lopez. That might be another new name. You guys continuing to tell your friends and your family about the show is just bringing so many wonderful people here. Rena, it is wonderful to have you. We've got the ringmaster, Andrew Barnhill, checking in and saying hello and good afternoon, everybody. Man, we've got so many good folks here. We got Noah Randari, the man that everybody knows his name, Noah Randari. Thank you for being here, Noah. We got past royalty here, a past guest on the show, Misty Johnson, checking in from the Denver area as well. And I've got Dennis Johnson. Oh man, Dennis, Dennis says go Dogs, which, as a Gator, there's not much I can say right now. There's no trash that I can talk to the Georgia Bulldogs, which is tough. We just have to sit here and take it as Gators, but yeah, we'll give you your due there. I recognize your go Dogs, so there you go, Dennis. Thank you for being here. We got Bob Wiedner saying hello from St. Augustine today. All right, Bob's all over the country. Great to see you here locally here. And man, do we have anybody else here who is checking in? Man, I see so many good chats going on. Continue to use the chat to your advantage. Again, make a friend, join the community, and for anybody who's lurking out there, who maybe hasn't said hello, use that time. It's a great way to make some friends. And with that, we're going to jump into the show today. Again, for questions and answers, please use that Q&A tab. And today, we're going to get something that's been on my mind for a while here. I'm going to get it off my chest a little bit. We're going to talk about the biggest mistake you make when it comes to cash-on-cash returns. And this is something that, at JWB, we have about 100 folks in the office. And so these opportunities that we get to train the team are really important. And the team came to me the other day and asked me to do a little training on stock market, on bonds, on rental property investing, and how they differ, the pros and the cons of each. And I said, okay, let me do that. This is going to be great. So I put together a case study, a 20-year case study of how stocks performed, bonds performed, and rental properties in Jacksonville have performed. And if you put $35,000 of your own money in 20 years ago, how would you have fared? And so I sat down, and the presentation was on a Tuesday, and I kind of procrastinated a little bit. It was Monday night, and I was putting the presentation together, and it was about 11 o'clock. I was done, and my wife was just falling asleep, and I was done with the presentation, but something didn't feel right. And so I politely probably woke my wife up a little bit, and I said, hey, babe, I was like, what do you think about this presentation? And she gets this from me all the time if I'm about to present something. She goes, she's my most trusted confidant. I will certainly tell you that. And she never holds back. And she looked at the presentation, and I said, is this boring? And she goes, yeah, this is boring. You need to do better. So I got back to work, and I started to rethink about how I could tell and teach and train on the differences between stocks, bonds, and rental property investing. So this is what I came up with. Today, we're going to take a journey down this path, learning about the biggest mistake you make on cash returns through the lens of one of the great American stories of all time. I'm talking about the Karate Kid. And if we have any Karate Kid fans out there, let me know in the chat right now as I bring this presentation up. I think you guys, I don't know if you were expecting to hear about the Karate Kid here today, but we are going to jump into it because I think it gives us the framework for telling the story the way it should be told. So here's what we're going to do. We're going to talk about this case study, stocks, bonds, real estate, a 20-year case study. And for anybody who is not a JWB client, if you have additional questions, if you're a JWB client too, if you have additional questions, go to chatwithjwb.com. You can set up a time to speak with my team. Won't have all the time to go into everything we want to get into today, but that's a great place for your next step. What we are going to talk about is a Karate Kid. So when we're thinking about the Karate Kid, you've got the classic good versus evil. You've got the Cobra Kai dojo, and you've got Johnny over there in the black gi. All right. And then you've got Danny LaRusso. He's over there in the white, right? And we know the story here. We've got Johnny, who is the established presence for the All Valley Championship, the karate competition in his school. And that's what you would bet on as far as being the place to go if you wanted to pick a winner for the All Valley Championship. So that's Johnny over there. He's going to represent stocks and bonds in this little story here. And then you've got Danny LaRusso. Danny LaRusso probably isn't the winner that you would pick if you were going with betting odds on who was going to win the All Valley Championship, right? But we're going to call him Jacksonville Rental Properties. So you've kind of got the establishment here, right? Johnny and the black gi and his sensei. Oh man, I can't. John Kreese. I just looked up the sensei's name. That's right. He was no mercy, and Cobra Kai was the establishment. This is the place that people go to invest typically. Average investors typically invest in stocks and bonds because that's what everybody does. That's who everybody thinks is the best way to invest. And it's a little bit intimidating for other asset classes. So you look at Danny over there, he was definitely getting intimidated. He just moved to the school. He was a new kid in town. He was a little bit thinner, right? Didn't have the fancy gi to wear. And you can start to think about this in terms of how different you need to be to go full on into investing in single family rental properties, right? You're kind of the weird one at the party when people are talking about their investments. I don't know if people talk about their investments anymore at parties, but if they were, you would be the weird one, right? You're doing something different and it's a little bit intimidating. Why do something that average investors are not doing, right? Why do something a little bit different? So I think we all can kind of feel that. I know I felt that, especially in the beginning, and I'm sure some of you can relate. And then you start to think about just how the media portrays rental properties. They portray it as something that it really isn't many times when it comes to the returns, which we're going to talk about here in a little bit, but also what's going on in the market today. You've been reading articles for years and years now about this impending crash. Well, it hasn't happened. This crash is not going to happen during this period of time right now. But the media would have you believe otherwise when you read some of those articles. And, they said there was going to be a crash when the pandemic happened. They said that then there was going to be a crash when this eviction and foreclosure moratorium went away. And those crashes never seem to happen. You just don't tend to see that for other asset classes. So they kind of intimidate us. And we certainly see that in Cobra Kai and Danny there. So I wanted to dig into the numbers here. All right. What I did is I looked back over the last 20 years. And I look to see stocks and their income and their appreciation to get the full picture of how an investor would earn a return on their money over the last 20 years. And so I went 20 years ago, and if you were investing in the S&P 500 index, you would actually earn a dividend, which is income. It's another way of just fancy way of saying income or yield or dividend or cash flow. You would have earned on average about a 2% dividend, which is more than a typical stock investment. Most stocks do not pay income, do not pay a dividend. But for this example, I want to put Johnny in the best light possible. And so you would have earned 2% on your investment over the lifetime of that per year on the lifetime of your investment. Over the last 20 years, you earned 2% of the value of the stock. And then from an appreciation perspective, the S&P 500 appreciated, the value of it went up 7.6% per year for the last 20 years, each year. Pretty good on average. Now let's take a look at bonds. So bonds pay more income. It's called a coupon. It's a yield. It's income coming to you, which is why people like bonds. The problem is you can't really reach your financial goals with bonds. Most of us can't because you just don't have upside. And for this example, I'm assuming you're holding bonds to maturity, which is what most people do. And your appreciation over those 20 years is 0%. So you're seeing 5% of yield or income. That's good, but no upside there, which most people know. You don't go to bonds to try to get ahead from a financial perspective. It's a conservative or a safe play. And then there's Jacksonville rental properties here. And for the income, and when we're talking about the biggest mistake you make with cash on cash returns, I'm putting 0% here for a cash on cash return for Jacksonville rental properties. That would be assuming that you have $0 of positive cash flow. Now, for any of our clients who are on the call and those who invest in Jacksonville, Jacksonville's a special market. You do get positive cash flow. All properties that JWB offers have positive cash flow. But for this example, I wanted to put Jacksonville rental properties in as negative a position as I could. So I'm going to assume that it's 0% for this example. And then I went look back over the last 20 years to see the average appreciation rate. And Jacksonville properties appreciated at a rate of 5.2% per year over the last 20 years. That's 5%, 5.2% per year, year over year, over the last 20 years. So you're looking at this and you're saying, if you're thinking about where the average investor thinks you earn better return on investment, you look at stocks and you'd probably say that's the clear winner. You got income, especially the S&P 500. You got appreciation that's higher than bonds and rental properties. And this is the lens that most people look at the decision of where to put their money, as well as the fact that investing in stocks and bonds generally is easier than investing in real estate if you're not investing with a vertically integrated provider. So you can kind of see why people do this. But this doesn't tell the whole story. No, my good friend Danny had an ace up his sleeve. I would love for some crowd interaction here. It's kind of lonely here. Tell me, who is this incredible individual that helped Danny LaRusso reach his best self? Go ahead and put it in the chat there. I know you guys know who this is. Who is it? Mr. Miyagi. That's right. Andrew Barnhill coming in for the win there. Renee, thank you so much. Yeah. So it's Mr. Miyagi. Mr. Miyagi was here to show Danny how to maximize his returns in rental properties, but more than that, it was how to help him understand the inner beauty that he had. And he started with this. And when you guys see this part of the movie, what is Miyagi teaching Daniel here? He is teaching him how to grow bonsai. And when I think and see bonsai, I think of cash flow. I think of income. I think it growing over time. And that's what Miyagi was here to teach Daniel. So now let's start to take a look at all 5 of the profit centers here. So if you invested, there we go. If you invested 20 years ago, you invested $35,000 on the income side from the stock market, from the S&P 500, you would have earned just under $33,000 in income, which is fantastic. That is wonderful. On the bond side, you would have earned $35,000 in income. Again, that's where bonds win. They pay you income. Don't give you much upside, but we like the income thing. But on rental properties here, you've got $32,000 of income. And I want to take a little bit of a pause here and stop the screen sharing, because if we go back and think about that 0% cash on cash return that we talked about for rental properties, why do you guys think that we had 0% when it came to cash flow? But now all of a sudden, we've almost caught up to the income side for both bonds and for stocks. Let's see. Go ahead and put it in the chat. Why is this happening? Why are we able to develop almost as much income as we were in stocks and bonds, but we had 0% for cash on cash returns? All right. Throw an answer in there. It has to do with rents going up for sure. And it also has to do with your major expense on rental properties staying flat. Your major expense is your mortgage payment. And that mortgage payment has this beautiful fixed rate. And so you've got 2 things working in your favor. Your major expense is staying flat, and rents go up over time. So what this creates is an opportunity for you to earn significant cash flow, significant income, just about as much income as you would have earned in stocks and bonds, but you earn that from rental properties. And so all of us out here are thinking about how to make this decision on rental property investing. And all I hear, the first question I hear when I sit down with a new investor, in fact, a friend of mine was just in the office about an hour ago. I was sitting down with him, and he said, well, how are the cash on cash returns for your investments? And when I see that, the biggest mistake that you make with cash on cash returns is that's all you guys think about. That's all you think about. But after 20 years, if you're comparing stocks, bonds, rental properties, you're going to be right there when it comes to income that is created. Now, it's a good thing to think about an asset paying for itself. But the biggest mistake that investors make is that's the only thing that they do. That's the only thing that they pay attention to. If 17 years ago, when I bought over 300 I bought 40 17 years ago and now own over 300. If 17 years ago when I bought those and every other time all along the way, all I looked at was cash on cash returns, I would have made poor decisions with my rental property portfolio. So we got to focus on more than just income. But that's what Miyagi was here to help us understand. So let's jump back there. After the first profit center, income here, we're just about where we were for stocks and bonds. Now let's take a look at another profit center here. Miyagi is helping Danielson here. He's helping him with this wonderful part of the movie. He's teaching him about wax on, wax off. For those of you who are just listening on the podcast, you don't get the full experience. You got to join the show next time. But I'm showing a picture of Miyagi doing wax on, wax off with Danielson. And to me, this is more like wax on, tax off because we're getting into tax savings. And you all know how much I love tax savings here. Well, tax savings are not there on stock investments. They're not there for bond investments. But for rental properties, you get this beautiful thing called depreciation from a tax perspective. It's not depreciation from the market value. This is different. But depreciation from the tax perspective allows you to write off and defer paying taxes on income that you otherwise would have paid taxes on if you had earned that in stocks or bonds. And it's not insignificant. Over this 20-year hold, you would have saved $9,400 in real dollars that you don't have to spend. So that's $9,400 more of return on investment from tax savings. If you need more information on this, again, go to chatwithjwb.com. Set up some time to speak with my team. We can walk you through it. $9,400. And most investors, for those investors out there who say, what about only about cash flows? What about cash on cash returns? Tax savings, not a part of cash on cash returns. So you got to look beyond that. Next, let's take a look at this wonderful part of the movie, right? For those who are listening on the podcast, this is where Miyagi is using chopsticks, and he's teaching Daniel's son about using chopsticks to catch a fly. And when I'm thinking about the time and the patience and the discipline that it takes to earn, to be able to catch a fly with chopsticks, I'm very well versed in this. I can do this all the time, of course. When I think about that, it makes me think about the time and the patience and discipline that you require to earn principal pay down. Right? Principal pay down is this beautiful thing where your resident is paying down your loan for you. And it's set up and it's built in with your loan and a cash flow positive investment, which you have. And this happens every single month. You just don't see it in your bank account that day. But when you log into your loan balance after 1 year, 5 years, 10 years, 20 years, you'll understand that your loan balance is paid down a whole lot, and that wasn't from you. That was from your resident. And again, it's not insignificant. This is about $45,000 of additional return on investment that you would have earned from principal pay down. This is incredible. Again, most people, the biggest mistake that they make with cash on cash returns, it's the only thing they focus on. Nowhere does cash on cash returns pay attention to principal pay down, but that's 45 grand in your pocket, whereas income was only 32,000. So it's certainly something we need to evaluate. As we're working our way through the profit centers here, now we've got Miyagi teaching Daniel about how to fight. He's teaching him the ways of karate in this picture here. And that, I don't know what that has to do with home price appreciation, but you know what? This is our big knockout punch when we talk about rental properties versus other asset classes. You've got stocks here where after a 20-year hold earned $116,000 in stock price appreciation. Now, is that a great return on investment? Yeah. Stocks appreciate over time because they are cyclical. And if you give it 20 years, people generally do pretty well in the market. So this is not a presentation on why you should never invest in the stock market. I think there's a place for the stock market for sure. But when you start to look at some of these other asset classes, the question you should be asking yourself is, does real estate, does direct ownership of rental properties also deserve a seat at the table? And I think the answer is yes. So $116,000 is a great return from stock price appreciation for the S&P 500. The problem with stocks, of course, is you don't know which phase of the market cycle you're going to be on when you need to access it. And anybody who's been investing in the stock market over the last year, unfortunately, is feeling some of that pain. And there's probably more pain, unfortunately, as we potentially go into a recession when it comes to the S&P 500. On the bond side, we know this. You don't typically get to your goals through investing in bonds. Bonds on that side, we know we don't get to our goals that way. They don't represent upside. And so you, of course, would not have seen any appreciation for that bond. Now, Jacksonville rental properties, you get $192,000. This is what you would have earned. If you invested 20 years ago, invested $35,000, you would have earned $192,000 in home price appreciation from your Jacksonville rental property. 192 grand. Okay, this isn't made up. This is actual numbers. But here's the really interesting thing. If you remember, we went through the different appreciation levels over the last 20 years. Stocks appreciated at a rate of 7.6% per year. Rental properties only appreciated at a rate of 5.2% per year. So if we're going back to this chart and understanding all 5 profit centers, or excuse me, I'm only putting 4 of the profit centers here. I'm keeping inflation hedging out of this to keep it simple. But from an appreciation perspective, $116,000 in stock price appreciation is lower than $192,000 in rental property appreciation for your Jacksonville rental property. How can that be if your appreciation rate is higher for stocks versus rental properties? Great time. If you know the answer, throw it in the chat. We'll see if you guys know the answer there. What is the key and why 7.6% would actually get you lower total appreciation when it comes to this overall? Look at you guys. Steve Schwartz says leverage. Denny Davies says leverage. Raj says leverage. John Henning says leverage. You guys got it. It's the beautiful part of rental properties, of real estate. It is able to use smart debt leverage. And when you invest in an asset that goes up in value over time, and of course is risk mitigated because it pays for itself every single month, your total return on investment from appreciation is much higher. And here's just a simple example, right? Everybody grab your phone right now, okay? Everybody grab your phone. Bring up your calculator here, all right? So let's just say that you invest in anything. We'll just say it's anything. And you earn $5,000 from that investment, and you had to put $100,000 down for that investment. So you can put 5,000 in your calculator divided by 100,000, and that gets you 0.05, which is a 5% return on investment, 5,000 over 100,000. So let's just say that that's what you did for a rental property. Let's say you could buy one for 100 grand just to keep the number simple. Well, if you buy that $100,000 property, but you only have to put 25% down, well, that equation changes. Now the equation is $5,000 divided by 25,000. And that gets you this number, which is 20%. Okay, so how did that happen? Well, return on investment is, by definition, taking your return by how much you invested. Well, you only invested $25,000 of your own money. And this is why you're able to earn a much higher return on investment when you use leverage. And this is why rental properties beat the pants off the stock market when it comes to total return on investment over the long haul, because of this beautiful thing called leverage. And that's why 5.2 can actually beat 7.6. So there we go. We've got all of these profit centers. I went through 4 of the 5. There is a 5th one, inflation hedging, which I'm just not going to get into for this demonstration here. But this is setting us up to see how it all pans out for the All Valley Karate Championship. You've got the establishment, you've got stocks and bonds. The average investor will only invest in those versus Daniel LaRusso, who doesn't look like much at the surface, but he's been trained to unlock his inner beauty through all 5 profit centers by none other than Mr. Miyagi. And you guys can probably imagine how this turns out. Overall, for 20 years, if you invested $35,000 in the stock market, you would have earned 9.7% as an internal rate of return for a total return of just under $150,000. Again, a great return on investment. Wonderful to have a seat at the table for stocks. Bonds, you would have earned 5%, $35,000 there, all in the form of income, no upside. You're not getting to your goals by bonds. So certainly something is a defensive play. There is many times a play for bonds in folks' portfolio, depending on your goals, but it's certainly not the way that you're going to accomplish your overall financial goals if you have a bond heavy strategy. And then there's rental property investments. You would have earned a 14% IRR, internal rate of return, if you invested 20 years ago in a Jacksonville rental properties, and your total return on investment, $278,570. Jacksonville rental property investments outperformed the S&P 500 by 44%. Now, to me, what this represents is time. This is a quicker realization of your financial goals simply by investing in an asset like direct ownership of rental properties. And all we're saying here, And hopefully what this example shows is that it deserves a seat at the table. The vast majority of Americans never step outside of their comfort zone, never step outside of the average, and never find a direct asset class. But when you think about consistency and return on investment and experience and the ability to use leverage, there's so many things that can help you accomplish your financial goals, get there quicker, and you don't have to go 100% all in. It just deserves a seat at the table, is what I believe. All right, but Miyagi wasn't done yet. Okay, he helped Danny win the All Valley Championship, but he wasn't just trying to teach him to win just one championship. He wanted to be the best man he could be. That's what Miyagi was here for. And so this is what I think about rental properties. I think about my decision to invest in rental properties 17 years ago and leaving my corporate job and jumping in, and I'm not an entrepreneur. I wasn't an entrepreneur before. I didn't come from real estate experience. What I loved about this, guys, I worked in corporate America. I'm conservative. Like, the thing that made me jump here was not the incredible upside of rental property investing. It was mitigating risk. It was the best part of mitigating risk is seeing that income grow over time. And that's what Miyagi was telling Daniel-san about how he could grow over time. I guess I'm kind of stretching there. There we go, right? Here's what I'm saying. If I took this example out year over year, I want you to see not only how all 5 profit centers work, but how the income works, because income in your pocket is the best way to mitigate risk, okay? So year 1 here, you had $58 a month coming in from the dividends from the S&P 500 in the stock market. There you go. Bonds, you had $146 per month coming in. Okay. And rental properties, for this example, again, I'm saying $0. Again, we know that you do have positive cash flow, but I'm making this thing look as bad as possible for rental property investing. By year 10, things start to change. Stocks, you've grown because your asset has grown over the first 10 years of this case study. The S&P 500 absolutely grew in value. And so your dividend grows in value. You're at $121 a month. Bonds, you're still holding strong at $146 a month. That's not going to change because that's how a bond works. But rental properties, after year 10, you've already passed the stock market. You've already passed the S&P 500. And by the way, the majority of stocks do not earn dividends. So you are lapping every other stock investment. You got $134 a month in cash flow coming in in this real case study of what happened over the last 20 years. You're almost caught up to bonds in 10 years. And you're growing year over year over year over year. You don't have to just wait for this to happen and hope that it happens. It happens year in and year out. That's why I love the risk mitigation component of this. By year 20, things really start to get interesting. You've got $252 in stock dividends, which is great. That's growing. Bonds still staying strong at 146. Jacksonville rental properties up to $418 a month. So this is why you buy and hold. It's one of the reasons you buy and hold, because this is like a fine wine. It gets better and better with time, right? You hold on to these assets for a full market cycle. Your risk mitigation grows because your income is growing. And then, of course, you get to take advantage of all the other profit centers, which we just reviewed. And then something amazing happens in year 30. What happens in year 30 when you have a rental property? And it has to do with that question I asked earlier. Let's see. Let's get a little bit more crowd involvement here. Go ahead, throw it in the chat. What happens year 30 that dramatically increases your monthly cash flow from the rental property investment? What do you guys got out there? It's something that has to do with that loan that we took out. The loan is paid off. Raj, thank you so much. Kyrie from our team, mortgage paid off. There we go, right? Thank you guys for continuing to be a part of this. Your loan's paid off and you didn't pay it off. Your resident paid it off for you. But after 30 years, you've got about $1,400 a month you've got from rental properties coming in. Truly life-changing at that point. Stocks, if you still held on to that investment, you would have earned $525 a month, which is great. It only pales in comparison because of what rental properties have done. What you see over bonds, bonds clearly not going to get you to those goals, still $146 a month. So you've got 3 times the amount of income coming from Jacksonville rental properties, 3 times better than the S&P 500. And the S&P 500 is not a typical sector of the stock market. Most stocks don't pay dividends. We're looking at the best of the bunch typically. So this is how your life can change. When you think about the biggest mistake of cash on cash return or that you make, it's that you focus so much on it. It's the only thing you pay attention to year one. And after 10 years, your cash on cash returns are going to continue to grow. After 30 years, your cash on cash returns are going to, in this case, triple what you would have had in the stock market. And it's not dependent on the value of the asset, right? 20 years ago or 30 years ago, if you made this investment and you were sitting here right now, no matter what home prices do, rents would continue to come in. And in the stock market, it's not that way. If the stock value drops to 0 overnight or drops in half overnight, your dividend drops in half overnight as well. So this is not just income that continues to be built up year over year. When you need it, it's there to support your lifestyle and it doesn't go away. Many people don't realize, but rents for our entire country have never decreased year over year. Never happened one time. So it's consistent income that is there when you need it. And that's what we love about this beautiful asset class. But I'll tell you, nothing about this asset class really appeals to busy professionals unless we can make it easy. And that's why this approach of vertical integration is here. We pioneered this vertical integration approach. It's what we've been building our business around here at JWB for 17 years. And it's because I believe it is the best way for busy professionals to take advantage of this asset class. If you're somebody who has more of your own money in stocks and bonds, and you're just feeling like you're trapped between a rock and a hard place, and you know that in recessions, the stock market doesn't do well, and you're thinking, I would like to get into direct ownership, it's going to be really hard for you to do it unless you have a team that's there to support you. And that's what vertical integration is. That means that everything is under one roof. And that's what we do here at JWB. We've got your acquisitions, your construction, your property management, your accounting, your sales, your marketing for your rental home, your leasing of your rental home. It's all under one roof. So you don't have to go out and find 15 teammates and hold them accountable. You have one phone number to call for the life of your investment. And that's why it works. And for those who maybe aren't clients yet, I just wanted to give an overview. Sometimes folks are a little bit confused as to what they're investing in. So I just wanted to make it really simple. This is the JWB way of investing. You're investing in single family rental properties here in Jacksonville, Florida. And it's simple. It's 100% direct ownership of the asset for you and by you. This is not a fund or a syndication or a REIT. It is our vertically integrated approach. And that's when all aspects are under one roof. And I can see that we have a few questions here. If you guys want to throw some questions in, I'm going to make sure we have enough time here to answer those questions towards the just in a couple of minutes here. So go ahead, feel free to fire those questions into the Q&A. If you have questions about vertical integration, about how we got to some of these returns, happy to spend that time with you here today. But overall, this investment is built for these residents to have zero contact with you. You are not a prototypical landlord here, right? You are an asset manager who is maybe reallocating some of your assets from only stocks and bonds into direct ownership of rental properties, and you have a team to support you. Don't think of yourself as a landlord here. Think of yourself as an asset manager. And our team handles everything for you. You have full control over the assets. So some of you might be investing in REITs. Some of you might be investing in syndications or funds. And syndications and funds, when we talk about control, is more of a differentiator. You don't have full control when you invest in a fund or a syndication. I know I invest in funds and syndications, and sometimes the best laid plans for that syndication operator or fund manager don't exactly happen. And sometimes, when you think you're going to get your money back in 5 years, not 5 years, maybe it's 7, maybe it's 10. So you don't have full control. You do have full control on this asset. There are no lockup periods. There's no extended contractual agreements. And then you participate in the upside of the asset completely. All the appreciation is yours. Not like a fund or syndication manager or partner. They tend to take a piece of the pie as that happens. And so overall, JWB clients through this approach have earned 79% more home price appreciation than the average Jacksonville investor since 2013. And I just think I just think this is the right way for busy professionals to do it. So I hope it rings true to some of you. Let's jump into some of the questions that you guys have right now. And wow, almost 60 folks here being here for this hour. Goodness, thank you so much. And thanks for everybody being so supportive in the chats. All right, we've got Denny Davies. And Denny's giving me some really good advice for the military, man. He said, second family, instead of a salute, how about a tip of the cap every time for our military families? You know what? Absolute tip of the cap for all of our families, all of our military families, Denny and his family, of course, and those who are here keeping our country safe. We appreciate you so much. And we're absolutely going to do that going forward there, Denny. So thank you so much. Mountain Man, Bill Green says, I recently took out 2 loans for 2 different JWB properties. Is the amortization rate regulated somehow, or is it different depending upon the lender? Great question, Bill. So amortization schedules are dependent on the loan, the amount of years that you take out the loan for. So it's not dependent on the lender. The same, any lender who gives a loan with the same terms will have the same amortization schedule. Now, you can have 30-year loans that are amortized over 30 years, and that will be the same depending on whichever lender you're with. And that's how your loans are for your JWB rental properties. And we just keep it really simple and vanilla because this asset is meant to be passive and easy, and we're not trying to get too cute with different lending terms. If I go one step farther, you can have different loan amortizations. If you have a 30-year loan, you could have it amortized over 10 years or over 20 years or what have you. Those types of things can exist. But for your properties, Bill, it's all the same, not dependent on the lender. It will be dependent on how many years you took the loan out for, and it'll be the same amortization schedule for both of those loans. Good question. Thank you. Stevie B says, is your bond example looked upon the same as private money lending? Is your bond example to be looked upon as the same as private money lending? Well, great comparison. So for those who aren't familiar with private money lending acts very similar to a bond. Private money lending is where you lend money to a developer like JWB. JWB has a private lending program. We've borrowed over $300 million from our lenders, and then we use that money to do all the volume that we do to build the houses that we build and whatnot. And we pay a set interest rate to you as the borrower, which is the same thing that the federal government does or a company that offers a bond does for their bond investors. There's a couple of differences, though. Number one, it's the return on investment. JWB pays 10%, whereas your typical bond investments, a year ago, 2 years ago, were paying like 1% or 2%. Now they're paying roughly 4%, and it can go up a little bit from there, depending if you're taking more risk with who you're letting borrow your money. So big difference there as far as 10% versus something that's substantially less. And the other thing that's different is you have security in the investment when you're doing private lending. You have a mortgage and a note and other elements of security when it comes to a private lending investment. You don't get that in the bond market. You're relying on that company or the federal government to pay you back, which the federal government, they can just print money at will. So that's a pretty good bet they're going to pay you back. Companies, not always the case. And so you have a debt instrument, you have a mortgage, which at the end of the day protects you in the event that something would go wrong from a private lending investment. So some things can be looked at similarly. For private lending, you don't take advantage of the upside long-term from investing in the asset. So you don't get the upside for JWB private lending. You get that 10%, but some key differences from a regular bond as well. Great question. Thank you so much. We've got Kelly Berenbaum, our favorite guest here, who was just on just a couple of shows ago, favorite financial advisor. Kelly, thank you so much for the question. You say, can you talk about the process for new clients? I think it was like a 3-meeting process. It would be good to highlight the process and the reasons for the gating of the process. Great question, Kelly. I think this will be helpful. So when most people invest in rental properties, I think they do it backwards. They're so transaction focused. They typically, find a house in their neighborhood that they think would be a great rental property. Then they find a real estate agent and they go out and look for houses. And it's all based on that proximity and maybe their friend or family member or whatever real estate agent. And that's how it goes. They go property first and they never really get any farther from that. For us, we go team for our clients. they make their decision on the team first. After they fully buy into the team and the model, then they decide on the market. And we start to talk about the strengths of the Jacksonville market. And then third is the property selection process. And that's the reason why we go much slower when it comes to bringing clients on board. Kelly just purchased her first rental property probably about a month ago. And for all new clients, you're going to see probably a 3 or a 4 call process where we sit down with you. We understand what your goals are, what your resources are. We talk about our model, see if it makes sense to you. Because, this isn't just one house that you're going to be deciding on. Even if you only own 1 or 2 or 3 or 4 properties, there are thousands of decisions that we're going to make on your behalf in order to make this a easy and passive process for you. So we need to get inside both of our collective heads here. Do you like the way that we make decisions? Does it make sense to you? Do we like the way that you make decisions? Does it make sense to us as well? So there is a absolute feeling out process for a couple of phone calls. We then sit down and actually map out the plan, right? The goals that you have, the resources that you have, we break that down into a buying plan. So we understand, when can you accomplish those goals? Are those goals realistic? And we do that through a phone call and a planning process with you. And then, of course, we get to property selection. And Kelly, maybe you can chime in on this too. It should be easy. If we spend a few hours on the phone together getting to know exactly what you're looking for, then we put together a list of curated properties that we own. So we're not out there just finding properties on the multiple listing service. We put together a curated list that fit with your goals, and you get to choose about those properties. And it's simple and enjoyable. And so it's meant to make sure that we truly are finding the right fit. We absolutely mean that, because we want this to be a 10, 20-year plus relationship, and we want it to be a great thing. So we're a little bit slower. We are a lot slower than most, and we do it for a good reason. And it tends to work, because then we have great client relationships, just like Kelly. So thank you so much for the question, Kelly. And we have Steve Schwartz coming in. Do you have all partnerships with any mortgage lenders who offer preferential rates for your investors, given the confidence that they have in property performance from their experience with you? Great question. We do have very strong relationships with mortgage lenders. They give preferential treatment, but I need to share with you that this can be kind of a nuanced answer, right? For all mortgage lenders out there, you're going to find a wide array of lenders, brokers, and so there will be some who are better than others on rates, right? We vet out all lenders to make sure that they are the best on rates for you. And that's important, because at the end of the day, rates are going to drive what your total return on investment is. And I also want you to know that we do not make any money in a referral fee from any lender that we send. It's important. I really want you to get the best rate possible. Now, as far as some of our lenders having better preferential rates than others, hard really to make that happen, because at the end of the day, the best rates for you are to go to Fannie and Freddie type of loans. These are your normal, vanilla, conventional financed rate loans. And so there's not like a lender that we're deciding, like a person in the back office at the lender that we're going to put you with who's going to say, oh, geez, you know what, because of JWB, we're going to drop their rate. These are the federally backed loans that you want. That's how you get the best rates overall. So we're going to put you in one of those products, because that's the best thing for you. Your service and the fact that the loan will actually close is going to come from the lender that we put you with. And at the same time, we are constantly analyzing the marketplace to find those lenders that have the best terms for you. So kind of a nuanced answer there. Overall, yes, our rates are going to be better than any mortgage broker that you would typically find off of the streets for ones who can actually close a loan for you. But at the end of the day, being in a Fannie and Freddie type of environment, it's not going to be possible for them to just say, well, just because we love JWB, it's going to drop much lower. A lot of it's due to the Federal Reserve, what they do with interest rates, and how that affects the rest of the economy. Great question there. Thank you so much. Raj Bantu says mortgage rates were very low after GFC, is that global financial crisis in 2008, I guess is what he's referring to. Currently, mortgage rates are relatively higher and are expected to stay higher as compared to the last 10 years. Does higher mortgage rates lower future price appreciations? Great question, Raj. Well, I don't think we've had this one on the show. So you're right. Mortgage rates, we have been in an era of QE. We have been in an easy money era when it comes to how the Fed has regulated interest rates after the global financial crisis of 2008 and 2000 through 2010, 11. Really took till about 11 for the real estate market to start to come back. And rates are expected to be higher as compared to the last 10 years, just because rates were so incredibly low the last 10 years, and especially since the pandemic. I mean, I don't think we're ever going to see rates that low again. I don't think the Fed wants that. So do higher mortgage rates lower future price appreciations? Well, I think a little bit more perspective is helpful here, because if you actually look over the last 30 plus years, the average interest rate for 30-year loans is 7.8%. And so you have seen over the last 40 years, going back since 1982, the average appreciation rate in Jacksonville has gone up 4.6% per year. And that's happened out over multiple market cycles. And so you've seen when the average interest rate being 7.8%, you've still seen home price appreciation happen over multiple market cycles. And so that's what I would expect to continue to happen, even though we are in a higher rate environment than what we have had over the last 2 years, and probably what we will have had over the past 10 years. Who knows? Who knows what's going to happen? That it may happen, it may not, but I think that's a worthwhile and pretty good guess there that our interest rates may be higher than what they were over the last 10 years. You're still seeing home prices go up. And the reason is because home prices are not subject to just interest rate fluctuations. The largest and what guides home prices is supply and demand. And interest rates have an effect on demand, but supply is a whole nother ballgame. And so that's one of the reasons, that's the strongest reason why you're not going to see a crash right now. You're not going to see a real estate crash, even though the media is calling for it. It's because we are so undersupplied when it comes to housing. So no, I don't think this affects or lowers the outlook for future home price appreciation in Jacksonville. I think you're going to see the same thing over the next 20 years that you saw over the previous 20 years, which is the same thing you saw over the previous 20 years before that, which is home prices in Jacksonville are going to go up call it about 4.5% per year. Great question, Raj. And Stevie B says, what is the right way to look at the increased cost of investing today versus 20 or even 5 years ago? Great question. What is the right way to look at investing today versus 20 or 5 years ago? Let's go back to that case study that we just did, right? For those of you who were investing 20 years ago, putting $35,000 on a rental property was a reason some of you said, I didn't want to do it. People could have bought rental properties in Jacksonville 20 years ago. And, if you put, that rental property would have been, call it $115,000. I remember people all the time 20 years ago or 17 years ago when I started to invest say, why would I ever buy a rental property for $115,000? Why would I ever buy that? And you look over the last 20 years, and if you made that decision to buy, even though 20 years ago we thought prices were a lot higher, relatively speaking, than some people thought they were. I was buying everything, but some people thought, you've seen that this has overperformed versus other asset classes. And they've created a whole lot more risk mitigation, a whole lot more cash flow. 20 years ago, if you invested in that rental property versus putting in the S&P 500, you'd be sitting on significant cash flow each month coming in that isn't dependent on the stock ticker. So it's a long way of saying how to evaluate investing today. Look at your alternatives today, right? Sure, price today is more than it was a year ago or 2 years ago. Guess what? In 3 years from now, you're going to look back at prices today, and you're going to say that was a deal. And you're going to look 5 years from now, 10 years from now, 20 years from now, you're going to say the same thing, right? I kicked myself. I bought 40 rental properties 17 years ago, and I wish I would have bought more, right? You will say that same thing if all you're focusing on is price. Your job as an investor is to use your resources and find the best risk-adjusted return and compare it to your alternatives. And right now, rental properties is a really attractive asset class. There is upside, but it is capital preservation. It is consistency in a world where you don't have a lot of consistency right now. So that's how I would advise making that decision of where to invest today. All right, everybody. Wow, it's 1:28, and you all were incredible. We collectively as a team here, we made it to the finish line. We have over 50 folks that are still here. Thank you all for being here. This is just such a special community. It never is lost on Pablo, Madison, myself, my entire team, that you all choose to spend hours a week here with us. Hundreds of you spend hours a week here with us, and I super, super appreciate it. I'm excited to have Pablo back in the saddle on Thursday, and I think Madison will be back too in the saddle on Thursday for our JWB Rental Income Property of the Week. And we're going to have a blast on Thursday, and yeah, I'm looking forward to seeing you guys there. Thank you guys for being here and supporting me, and have a wonderful Tuesday, everybody. Take care.